Hi, Ben Kingsley here. Welcome to my September economic and RBA update. And it is another jam-packed update with heaps of data to get through for this month. Key focuses are on the US Fed is going to war against inflation. The RBA is at it again in lifting rates. I want to talk about APRA in reducing the lending buffers that they've got. And finally, I'm going to do a bit of a property update and talk about from trough to peak when it came to the COVID experience. So without further ado, let's get into it. I always start with my updates globally, and I'm going to start with the US of A here. So last month, all eyes were on Jerome Powell's speech at the Jackson Hole Symposium. And here's what we learned from that speech. The Fed is totally focused on fighting its war against the US inflation story. And it's doing so, it's willing to risk a recession and keep rates higher for longer if needed to restore price stability. In his speech, Mr. Powell stated that the Federal Open Market, the FOMC, overreaching focus right now is to bring inflation back down to its 2% goal. He continued by saying price stability is the responsibility of the Fed Reserve and serves as the bedrock for our economy, and it will take some time and will be very likely to lead to some softening of the labour market conditions. He said tightening of the policy stance will bring some pain to households and businesses. Furthermore, he alluded that waiting too long to address inflation, the US runs the risk of even more pain for households and businesses at a later time if they don't act decisively now. Now, that was a big signal to the markets that the Fed is going to go to war against inflation by tightening rates in the US, and will do it swiftly and will go as high as they need to go to get inflation under control there. Now, US inflation is running hotter than here in Australia. And unlike Australia, their cash rate increases aren't deemed as impactful as when the RBA lifts the cash rates here in Australia, which means their cash rate might go higher than our cash rate that needs to go to obviously bring in that inflation over there. Now, why is that? Well, in short, the US has a different finance structure to their overall financial system over there. So cash rate movements aren't as impactful on households as directly they are here in Australia. Also, right now, the US is in risk of dealing with higher wage inflation as wages to continue to grow solidly over there. And that runs a greater risk in inflation being baked in to the US economy for a longer period. And we know that higher inflation is a drag on sustainable economic growth and usually results in very hard landings at the end of an economic cycle. This is why it's now clear what Mr. Powell and the Fed are going to do to their cash rate over there. Following this meeting, the odds of another rate hike of 75 basis points for this month have shortened even further. And post this increase, the markets are still forecasting in a further 135 basis points increase are still to come. So that's a big story. Now, looking at some of the other big economic data coming out of the US, we saw that the latest jobs data released last week show that the US economy added up 315,000 payroll jobs in August, compared to a downwardly revised 526,000 in July. This reading, although falling, still beat the market forecast of 300,000. Now, August is historically a weaker month for employment, but non-farm employment is now 240,000 jobs higher than the pre-pandemic level compared to February of 2020. The unemployment rate is actually rose to 3.7% from 3.5% in August on the back of increases in their participation rate, meaning more folks are currently looking for work in the US. Now, in closing out the employment story in the US, the JOLTS survey showed job openings in July still sit at about 2 positions open for every one unemployed person. Now, the number of available positions edged up to a very healthy 11.2 million in the month of July, Vacancies have exceeded 11 million since last year's, underscoring the strength of the US jobs market, which is driving wage growth. And as I mentioned earlier, it's making the Fed's job harder in trying to reverse inflation over there. Looking at their consumer confidence now, we saw that it rebounded more than expected in August after 3 straight monthly declines. The Conference Board's Consumer Confidence Index rose to 103.2 this month, up from 95.3 in July. Consensus amongst economists had the index rising to just 97.7. So it beat their expectations by some way. So some resilience is being shown by the US consumer. If we see another couple of 0.75 rate increases from the Fed over there, the confidence levels will be under sustained pressure going forward. We saw in terms of manufacturing, PMI fell 0.9 of 1% to be a reading of 51.3. We saw the services PMI fell 3.2 points to a reading of 44.1. And the competence PMI index declined 2.7 points to a reading of 45. So we're definitely starting to seeing a slowing in some of those indexes over there. And finally, on the property front, we saw the pending home sales index published by the National Association of Realtors dropped 1% in July to 89.8, the lowest since April of 2020. Contracts have declined in 8 of the last 9 months as higher mortgage rates bite, bringing buyer demand down. And as I flagged, this would be the case a few months back as the US economy slows. All right, so that's a wrap of the US. Let's now turn over to the China story. China continues to persist with its zero COVID policy, where cities or regions within cities continue to get hit with lockdowns to restrict the spread of COVID. At the time of recording this, we see that the BBC recently reported that Chengdu, a city of about 21 million people, is currently enforcing strict lockdowns there. These rolling lockdowns are forcing a stop-start impact on economic activity, which is still impacting parts of the global supply chain, as well as causing slowdown in the China economy as a whole. And even moving people around China is being discouraged by the Chinese government at the moment. This slowdown continues to show up in their economic data as well. So when we look at some of their data results, we see that the manufacturing sector contracted in August. The Xi'an Manufacturing Purchasing Managers Index, the PMI there, eased to 49.5 in August from previously being 50.4. This reading now indicates that manufacturing in China is now back in a contractory phase. For now anyway, profits at industrial firms fell in the first 7 months of the year. Profits in the January to July period declined 1.1% from the year earlier. These results compare with an increase of 0.8 in June. The Xi'an Services PMI released earlier this week showed a fall of 0.5 to a reading of 55, which is still in expansionary territory. So there's a lot of challenges in the Chinese economy at the moment. And so what are the Chinese government doing about this to combat this slowdown? Well, over the past couple of months, I've been talking about some highlighted stimulus package that they have announced. If this trend continues, we did see that the Chinese State Council having readied a 19-point package, including over 300 billion yuan, which is 43.7 billion US dollars, for financial tools meant to augment existing programs. The cabinet also pledged to approve infrastructure projects, and Beijing will support power generators to sell 200 billion yuan of debt to keep power prices lower. In closing out the China story, their economy will continue to ebb and flow up and down whilst they tackle the pandemic in their own unique way. Eurozone now, well, obviously the biggest story coming out of the Eurozone in the last couple of days leading into winter is all about the energy supply, giving their existing reliance on Russia for gas to be pumped through the Nord Stream 1 gas pipeline. Over the past weekend, it was reported that Russian operator Gazprom is taking the Nord Stream 1 gas pipeline offline because after 3 days of regular maintenance, they have discovered some further oil leaks in a couple of turbines. Now, interestingly, Siemens, who are responsible for the turbine maintenance, have come out publicly telling the world these oil leaks can be sealed on site and should not stop gas supplies from flowing into Germany and beyond. Now, this is another example of Russia playing hardball with the West and lying about why they had to stop these gas flows through this pipeline to Europe, effectively trying to penalise Europe for its support of Ukraine after Russia invaded their country back in February. Russia, outside of, say, China, isn't winning any friends globally with its short-term economic sabotage in the gas, oil, and food prices globally. And as we've talked about, is the main cause of global inflation playing out right now. Importantly, although this is going to cause pain for Germany and others in the EU over the next 12 to 24 months, they have learnt their lesson in not trusting Russia to live up to their commercial contracts and are proceeding to solve their energy requirements in other ways over the next couple of years, including turning back on nuclear power stations. We're seeing reports on that also. So when it is clear that Europe has solved its energy requirements via these alternative resources, we should expect to see oil and gas prices return to more normalized pricing. And this will be good news for energy prices globally and also for the world's fight against the current reign of global inflation. So it's an important message to take out of there. Let's take a look at some of the data coming out of the Eurozone. We did see the August manufacturing PMI was finalised at 49.6, edging down from the flash reading of 49.7. The result confirms the manufacturing sector contracted for the second consecutive month as those surging input costs and the unfolding energy crisis weigh on confidence in the EU. The services PMI eased 1 point to a reading of 50.2, and the composite PMI moved into further contractory territory, falling 0.7 points to a reading of 49.2. In some positive news, the unemployment rate edged down to 6.6% in July from an upwardly rise 6.7 in June. The jobless rate is now at a historical low from recordings dating back to 1998. All right, turning our attention now to global economies, I just wanted to focus in on the oil price. We talked earlier before about global slowdowns and how that impacts it. So although demand remains elevated in the EU to shore up supplies for winter, we've seen globally that oil prices falling on the back of slowing global economy, which reduces demand for oil, especially led by the US and China. In fact, at the time of recording this update, the West Texas Intermediate futures is trading around or below the average level recorded in February. Now, why is this important? Well, it leads back to the levels that we saw before Russia invaded Ukraine. Falling oil prices is good news for reducing input costs when it comes to inflation. So here's hoping that the oil price continues to fall over the coming months as economic expansion slows on the back of these rising interest rates. Rightio, it's now time to talk about the Australian economy now. And we always start with the RBA board meeting outcome. So what did we learn from today's RBA announcement? Well, what we learned is the RBA board has increased the cash rate a further 0.5% or 50 basis points to take the cash rate now to 2.35%. This tightening cycle is now the sharpest on record since the RBA was made independent body from government. Today's decision moves us closer to the neutral zone cash rate of at least 2.5% quoted by the governor and deputy governor in speeches they made back in July. So again, it's reasonably clear that we see at least a further rate increases over that neutral zone rate of 2.5%. So they're not done yet. By going beyond this range, it's also about the data we are going to be receiving in the next couple of months. What the RBA wants to see is a slowing economy. Make no mistake about that. What it has been seeing in the past couple of months is a resilient economy led by very resilient consumers. who mostly have jobs and a business outlook that, although also showing signs of slowing down, there is still some economic momentum playing out. Let's update ourselves on the statement of monetary policy released last month by the RBA and their latest forecasts. We saw that the RBA upgraded its inflation forecast for this year and next. It expects headline inflation to peak at 7.75% in the December quarter of this year, up from 5.9% previously. The RBA also now expects inflation to be elevated for longer. It doesn't expect headline inflation to return to the 2 to 3% target band until the end of 2024. Growth is expected to remain above trend this year, but slow considerably in 2023 to just 1.75%, a downgrade from previous forecasts, driven by the weaker consumer spending and slowing growth in public demand. And one might suggest on the back of higher interest rates, which will be exceeding the neutral zone of 2.5% to pull inflation back into check. The unemployment rate is expected to reach its bottom earlier and lower than previously anticipated at 3.25% by the end of this year. But as this manufactured economic slowdown begins to bite, the unemployment rate is expected to rise, albeit gradually over 2023 and 2024. With these forecast adjustments, there is a mixed bag in terms of when and where the cash rate will pause, and to allow the RBA to take stock as to the slowing of the economy these rates are going to cause. So CBA still has the cash rate pausing at 2.65 by the end of this year, but Westpac Group has the cash rate at 3.1% by the end of this year, and then 3.35 by February, before the RBA calls a halt to rate increases. Now, the minutes of today's board meeting will be very interesting reading when they release them at the middle of this month, in terms of giving us some clues as to what increases were being discussed. How much discussion was given to 25 versus 50 basis points, and where does that indicate its next move? Either way, what I've been saying now for over the last 6 months is that there is still some way to go. So please make sure that you're adjusting your household budgets accordingly. And a little tip here for those who do want to forecast maybe cash flows for their household, I would encourage you to use the More platform and use the Money Stretch free feature inside our More platform. So if you want to learn more about that and to register to use our free money platform, go to more.com.au and you can learn more about it there if you haven't already done so. So now let's get back to the economic data. GDP data is out tomorrow. That will be interesting reading in terms of how strong the actual Australian economy is, but we don't have that data yet. So let's get some idea in terms of the economic data and look at the macro story here in Australia right now, starting with the job story. So we did see unemployment pull back in July, ending a tremendous 8-month run wherein the labour market expanded by an accumulated 750,000 jobs. The pullback was led by full-time jobs, which posted their biggest fall since May of 2020 of nearly 87,000. Now, the number of unemployed people also fell. Unemployment dropped by 20,200, taking the total unemployment pool to 473,600. This result was the smallest pool of unemployed workers since August of 2008. And just to give you some idea of the working age population, it's almost 20% smaller than the employment population is today. So we've grown the employment population by 20%, but we still have very, very strong employment story here. In this relative fall in both employment and unemployment pushed the unemployment rate lower to a fresh 48-year low of 3.4%. The participation rate pulled back to 66.4 from a record high of 66.8 in June. The underemployment and underutilization rates continue to forge lower as skilled shortages are forcing businesses to adapt. The youth unemployment rate dropped to a record low of 7%. And for the first time since records commenced, 1979, there are now more job vacancies than unemployed people. That's right, you heard me correctly. Just like in the US, there are now more job vacancies than unemployed people, which is a terrific story. Looking at wages growth, we saw the wage price index, the WPI, rose by 0.7 in the June quarter, matching the quarterly pace set in the previous 2 quarters. In annual terms, wages grew by 2.6%, the fastest annual pace in nearly 8 years. I can promise you this WPI measure isn't a perfect measurement tool, which I've highlighted before. For example, enterprise bargaining agreements can last several years, making moving the dial harder in the WPI. In addition to that, employers are also using non-wage payments to retain and attract staff, including bonuses, which aren't factored into this data set. When you do factor in bonuses into the WPI, wages grew by 3.1% in the quarter. Private sector's wages grew faster than public sector wages and drove the increase in the WPI. Furthermore, for those employees in the private sector who received a pay rise in the June quarter, the average size of the increase was 3.8%, the biggest size in a decade. Some economists are forecasting continued wage growth, whereby it's possible that wages growth in 2023 could have a 4 in front of it. Now, remembering wages growth can be inflationary, so we need to have that in the back of our mind, but it's also potentially good for property prices in general as it increases the borrowing power of buyers over time. So certainly something to watch there in terms of those wage increases that are going to continue into 2023. Consumer confidence and sentiment data now. We saw the consumer sentiment ease for the 9th consecutive month in August, sliding 3 points to a reading of 81.2. A combination of rising costs of living pressures and interest rates hikes are hitting household budgets and putting overall confidence to the test. This latest rate rise will continue that story. In terms of confidence among mortgage holders, slipped 8.9 points in August to a reading of 79.2. Households are certainly reacting to the most aggressive rate tightening cycle since the introduction of the 2 to 3 inflation target introduced by the RBA in 1993. It's logical to expect this will translate into weaker general household spending as more household budgets get swallowed up in either higher mortgage or rental repayments for many. And this will start to show up in the data as we lead into the Christmas period. This should then also play into the mood and decision-making of businesses in terms of future hires and future business investment, leading to an overall slowing of the economy, which is really what we saw in the RBA forecasts and what the RBA is trying to manufacture. Now, retail sales now I was painting a bit of a sort of a somber story there in talking about confidence and sentiment, but looking at the retail sales figures for July, you could be mistaken in thinking that we are in a slowing economy at all. But we do need to remember this is July data and cash rate movements have been considerable since then as well. But we did see retail sales growth accelerate again in July, notching up the 7th consecutive monthly increases and taking sales to a new record high. Consensus forecast was just for a 0.3 of 1% increase. Instead, we got a solid 1.3% increase in retail sales in July. This takes the annual pace of growth in retail sales to 16.5%, the fastest annual rate since April of 2021. Now, that was on the back of bouncing back out of a lockdown that we had back then. Spending across retail categories was also active in July, especially in discretionary areas. Consumers splashed out on clothing and footwear in department stores, dining out, etc. However, it wasn't all perfect sailing for all retailers, as we saw household goods such as furniture and electrical goods fell for the 2nd month in a row, and back on the obviously slower turnover of the property market in general. Now, a betting man would also suggest that this slowing in retail sales will start to play out over the coming months. That slowing will trigger the RBA to take a breather in raising the cash rate. So I'll be watching very closely and with high interest over the coming months in terms of the retail sales data. It does need to slow down. If it doesn't, the cash rate will continue to rise as the RBA needs to obviously slow down that consumer, which represents around 60% of the economic output in our economy. Let's talk business activity now, starting with the business confidence and conditions. And again, we saw a story of businesses remaining relatively upbeat. Business confidence and conditions both rose in July. Business confidence rose by 5 index points to a reading of +7, while business conditions rose by +6 to a reading of +20. Both measures are above their respective long-term averages. Based on the employment story we talked about earlier, leading indicators suggest that capacity remains stretched as businesses try to meet strong demand for goods and services within the economy. Capacity utilization rose to 86.7, the highest on record and well above the long-term average. So productivity is improving. Looking at capital expenditure now, we saw new private capital expenditure grew strongly in the 2021-22 financial year, reflecting the strong economic rebound, both post-lockdowns and also the generous tax incentives of that time. In real terms, annual growth in Capex was 7.7% higher, while in nominalised terms, Capex grew by 13.3%, the strongest growth since the 2008-2009 financial year. But the weather is starting to shift as we look forward. In the June quarter, Capex declined by 0.3 to be 2% higher through the year to June. Through the year, growth rates have decelerated from 13.5% in the September quarter 2021 to only 2% in the current quarter. The weakness in this quarterly result has been driven by a fall in spending on buildings and structures, which declined 2.5% in the quarter. Spending on machinery and equipment rose by 2.1% over the same period. Now, businesses will continue to monitor the economy and respond to new trends as the economy starts to slow. This is whether the RBA is still playing a vital role, firstly in turning the tap off and then helping turning the tap back on once the confidence, once we're confident we have headline inflation and inflation back under control. Immigration, I want to talk about immigration. So we did see at last week's job summit, we learned that the Labor will increase the intake of new arrivals to Australia by another 35,000 folks, taking the annual intake to 195,000. This is great news for businesses screaming out for skilled human capital right across the board. Yet it will put further pressure on the housing market in the short term. But let's hope that we see plenty of tradies, along with nurses and IT professionals in the mix, arriving on our shores to help take the pressure off the labour market in the building sector and to help bring the cost of new builds back down from the elevated levels that they currently are. Not only will it make housing more affordable, it will also help bring inflation down, as obviously the basket of goods does include a lot of household items in there as well. Now, that's a good segue into talking about household credit. We saw that the credit growth in housing is turning lower in the July data, both for owner-occupiers and investment lending is slowing. Total credit extended for housing grew only 0.5 in July, which just happened to be the same monthly pace for lending to both owner-occupiers and investors. Annual growth in housing slowed modestly to 7.7 in July from 7.8 in June. It is the softest annual pace in 6 months. The peak of the cycle saw 7.9 back in May. Now, it's going to be interesting to watch in terms of investors' lending story. I mean, yes, there's definitely higher yields out there. They are on the rise, but the higher costs also needed to be factored into the risk-adjusted returns. So I'm interested to see whether that demand will start arriving from investors. It's also been my view for those who are playing along at home that the long-term property investment game receives the greatest rewards. But the short-term uncertainty also makes for easier buying opportunities when others are fearful. So I think that's also a message that I hold true for the long period of time, that property is a long-term investment story here, folks. In these uncertain periods of time, there are excellent opportunities as well. So I'd be interested to see where we go. Now, before I move on from property-related stories, I do want to briefly talk about APRA and the Council of Financial Regulators. APRA back in October last year increased the buffer rate for lending from 2.5 to 3%. Now that reduces borrowing power of borrowers as part of their prudent measures to keep the financial system healthy, when the cash rate was at a record low of 0.1%. Now the cash rate sits comfortably beyond what was the pre-pandemic cash rate, when that cash rate was only 1.5%. So we've moved from 1.5% down to 0.1. We're now way beyond that cash rate. Now that 3% buffer has played its role, but it's now impeding borrowers beyond its useful purpose by restricting them from potentially moving lenders for a better deal. Bringing this back down to 2.5% immediately and then looking to bring it down even further to 2% is actually a sensible measure. We saw the Bank of England reduce their buffer settings a couple of weeks ago, and now it's time for us to do the same. So if you're listening, APRA or the Council of Financial Regulators, it's time to remove this restrictive measure, please. And I did say, please. That's an important story there. Staying with the property and housing story, we saw construction work fell 3.8% over the quarter. This is the biggest fall in 4.5 years, to be 4.3% lower compared to a year ago. Private sector residential building work declined by 6.9% over the June quarter. It was driven by a 13.9% fall in the value of work of new detached housing. This is the largest fall in nearly 22 years and follows a 1.3% fall in the March quarter. Other residential constructions, apartments and townhouses increased by 3.3% over the June quarter on the back of an increase of 5.5% in the March quarter. However, forward indicators point to a market deterioration in this segment, as well as building approvals for high-rise apartments shrinking sharply last month. I know I've said this already, that residential construction is coming off its peaks on the back of the construction pipeline created by the home builder program that we saw. We would expect construction in the resi space to continue to slow for at least the next 12-month period. Until developers, builders and consumers believe that they are at the other side of further rate rises and the cost of building to start to fall. Now, this is going to put some additional pressure on supply on the back of increased migration story that we just talked about as they start arriving over the next year or two. So interesting, supply is going to be constrained. Demand is not quite there at the moment, but when that does come back, we are going to see again a housing shortage start to appear in this country. So now let's talk about the latest building approvals in support of that thesis. We saw building approvals declined by 17.2% in July this year to be 25.7% lower through the year to July. This fall was the largest monthly fall in 6 months. The fall was driven by approvals for those multi-density developments, such as apartments and units, which fell by 43.5% in July in the previous sector, the sharpest monthly fall in a decade. The fall was deepened by apartment approvals of 9 stories or more. So it looks like no one's going to build high-rise apartments during this housing slowdown. And that sort of makes sense given the developers are sitting on the sideline amid those elevated material and staffing costs. Approvals for houses are held up in July, rising by 1% in July. This was the softest number in 5 months, but the number of monthly approvals remains above the long-term average, demonstrating the resilience in this segment of the market for now at least. But I am expecting approvals for houses to also slow over the coming 6 to 12 months if property investors don't decide to join the party to build the much needed rental accommodation to house those overseas migrants who are coming to our shores. So it's quite interesting to see what's going to happen. The emerging short to medium term story of the supply story will be the lack of new construction. And this is going to create housing shortages, which I mentioned earlier, which is also going to put further pressure on short-term rents. So that's also something to keep an eye on. Now let's look at the August CoreLogic price and rental data. National dwelling prices recorded their fourth consecutive monthly falls, declining by 1.6% in August. This is the largest monthly decline since January 1983. House prices are now fallen by 3.5% since May of this year, when the housing correction kicked off. Generally speaking, it's clear markets are giving up some of their gains they enjoyed over the recent growth period. However, Adelaide, Perth and Darwin still remain in growth territory if you look at that over a quarterly period, with all other states and territories past their peaks over that same quarterly period. But one would expect Adelaide and Perth to also join the declining club in the coming months. That said, I thought it would be a good idea to go through some perspective in terms of those market cycles. I mentioned at the start of the update that I wanted to talk about the COVID trough to peak growth story and the current declines as they're currently at. Now, why is that? Because I wanted to give some perspective, remembering, that ultimately, yes, we are seeing a correction, but it's not as bad as people may be playing it out, or certainly how the media are playing it out. So, and I also want to remind people that property that you own maybe have done differently, worse or better than what I'm reading out here, because I'm only obviously talking about the capital cities and the general regional market. So they're indicative figures only. Your property that you bought or haven't bought or bought earlier may have done better or worse over this time. But let's quickly go through these numbers. So in terms of Sydney, from COVID trough to peak, the market grew by 27.7%. Now, it's declined since that time by 7.4% as at August. And the month that the Sydney market peaked was January of 2022. Melbourne, its trough to peak, 17.3% growth. It's given back 4.6% of that, and its peak was February 2022. In terms of Brisbane, very healthy 42.7% increase. It's given back 2.6% of that so far, and its peak was in June of 2022, a couple of months ago. Adelaide, 44.7, a very healthy number. It's only given back 0.1 of 1%, and that was last month in July. So is that its true peak? Perth has gone up 25.9% from trough to peak. It's only given back 0.2 of 1%, and its peak was also July 2020. Hobart, a healthy 37.7%. Decline so far has been 3.3%, and its peak was May 2022. Darwin, 31.1% from trough to peak, and it's given back 10.1% of that. But here's the difference. Darwin's peak actually was May of 2014. So it's still sort of rolling up through that peak period that we've seen here. So they aren't done yet in terms of their up cycle here. The ACT, 38.3% from trough to peak during COVID. It's given back 2.9% and its peak of market was June 2022. Let's look at some of the regions now. We did see regional New South Wales had a very healthy 47.6% growth cycle. It's given back 2.9% of that so far, and its peak of market was May 2022. Regional Victoria, 35% growth, given back 2.1% of that in May 2022 was its peak. Regional Queensland, 42.7%. It's gone back negative 2.2. Its peak was June 2022. Regional South Australia, 42.9%. It hasn't given any of that back, and that currently still sits in play as at August 2022. Regional WA, 30.1%. It's showing a negative 16.5, but this is again another story similar to Darwin. It hasn't really had a strong growth or peak to trough period because the peak of market for regional WA was back in January of 2008. So they haven't actually recovered back to the height of their peak of market, similar to Darwin, who hasn't recovered to their height of peak of market back in May 2014. In terms of regional Tassie, 51%, negative 2.3% given back, and that was June 2022. So combined capitals, we saw a 25.5% increase, giving back 4.2%, and the peak of market was April 2022. Combined regions, 41.6. So in the back of the pandemic, people moving to the regions or people buying second houses in the regions saw 41.6% growth. It's given back 2.2% of that, and its peak period in the market was June 22. So across Australia, in summarising that, we saw a 28.6% increase, and across the nation, it's given back 3.5% at a peak of in April of 2022. Now, remembering, there's no such thing as the Australian property market. There are markets within markets, and that's what I was trying to explain earlier as I stumbled through that, to sort of say your property may have done better or worse, may be higher or lower over that time period, but that just gives you some idea. So there's certainly still a lot of headroom in terms of the growth that's been had over this period, and whether those gains will all be given back, only time will tell, and that will probably be a product of where the cash rate goes, and how hard a landing the Australian economy will have. So finally, on the property front, I wanted to look at the current rental yield story. So across Australia, rental yields increased by 0.8% in August. Now, and those playing along at home, this doesn't directly mean that rents grew by this figure, because, in regards to rental yields, we need to understand a couple of things. As property prices are going down, rental yields just automatically increase. And of course, the other way in which rental yields increase is in regards to actually rents being increased. So it's not just rents being increased, it's also property price corrections in which factor in the calculation of yield. So here is the current state of play for those looking at the general property markets. Canberra's current dwelling rental yield is around 3.9%. Darwin's sitting at a healthy 6.2%. Hobart 3.8%. Perth at a pretty healthy 4.4%. Adelaide 3.8%. Brisbane 3.8%. Melbourne 3%. And Sydney still sitting at 2.9%. Again, I expect over the course of the coming months and even the next couple of years that rental yields will come back towards their long-term averages of around that 4 to 5% rental yield. Now, this is making the assumptions that retail interest rates will stay in that 6 to 7% range. Now, if they don't stay in that range and the cash rate goes down and what we pay in terms of our retail rates come back down and we're sort of paying in that 5 to 6% level, then I would expect that rental yields will only get to around 4 to 4.5%, generally speaking. So the cost of money is going up, rental yields, those costs are being passed on. It's a natural part of the cycle. We didn't have to have high rental yields when we had historically low interest rates, but now those costs are being borne by the property owner, and they're putting that up in terms of the rents that they're charging as part of that story. So huge month of data, lots to talk about. Thank you for hanging around and staying with me. Let's summarize those key takeaways. US interest rates are going higher and more likely to go higher than the cash rate here in Australia is. So I wouldn't be looking at the cash rate over there and saying that's where Australia's heading. They'll definitely be higher over in the US. In terms of RBA, they aren't finished with lifting the cash rate yet. Every month is a live story for them. It depends on how much they can slow the economy down before they start to take a pause on interest rates to see what's actually happening to the economy. They don't want to overcook it, but they also need to get inflation in check. As I mentioned earlier, APRA needs to come to the party in helping borrowers. They did what they needed to do. The world has changed. They need to reduce the buffer rate to allow more borrowers to be able to shop around. And finally, that immigration story is a very good thing for the economy overall. And it's also going to be helped in regards to the property market as we see that play out from a demand point of view. So that wraps up this big month of economic news. And so until next month, always remember that knowledge is empowering, but only if you act on it. And we'll see you next month. Bye for now.